This one's from Amir. It wouldn't be a mastermind session if we didn't get a question about interest rates. So that's okay. And I'm sure, disappointingly for just everybody on the call today, there was no rate cut. So Michelle Bullock, she's come out and she's just said, we're on hold. And that didn't go anywhere, which was a bit of surprise for, I think the money markets had basically priced in 90% certainty that they were going to see a rate cut today. So, and also a lot of the banks, I think, were starting to offer some rates pricing in a rate cut. So it was very surprising. And I guess the reason it was surprising as well, because I guess we'd now hit their band in which they had really been kind of pushing was the target range. So we've got a few things here. I'll just move this one so we can actually see the very top of it. That'll be better down there. So the monthly CPI, so consumer price index. Then we got the trimmed means. This is taking out the extreme ends on the high and on the low side. So the band which they've constantly talked about is that 2.5 or between 2 to 3%, which means they want 2 to 3%. They probably want us to be at 2.5%. So if we go back to say March 2024, we can see the kind of trim mean started in the early fours, kind of kept pushing slowly down, trying to get inflation down. It's not a quick thing. You can't just jack up interest rates and then inflation comes down tomorrow. It's kind of like trying to turn the Titanic. It's going to take you a good time to actually turn the boat around. So it's been a slow progress. Hiking rates takes time. Inflation basically really kind of stabilized, and I think some economists are basically saying we should have really started the cutting cycle from here in November, even though inflation was towards the higher end of their band, and now we're at the low end of 2.4. But they're waiting for the next quarter. Essentially, interestingly, they've used one of the reasons to not cut rates, saying that wage cost has gone up. But a lot of that has actually come because a lot of I think some of the benefit payments actually got a bit of an uplift. So you would expect that, of course, wages went up because they got a natural uplift. But I think they're just waiting to see what happens in the next month's data in the quarterly rollout, because they sit again in August. So it'd be very interesting. But they will have access to more data. They might come out and say, if we hit a 3 number on the next quarterly, then we might be holding, and they might have actually made the right decision. But in terms of, I guess, going back to Amir's question, so if rate cuts to be expected soon, so they were expected today. I think everybody's really shocked. If you're on LinkedIn, just about every broker, economist, property expert out there was saying it was a certainty today. So bit of a shock for everyone. I don't think I came across anybody on my feed that had factored this one in. In fact, even on news.com, they basically were saying it was a Monty that it was to be delivered. But one thing, I guess, to be aware of when the next rate cut does land, and I do think there will be at least another 1 or 2 this year, is don't expect the banks to pass down the rate cuts in full moving forward. So historically speaking, when rate cuts have started, they normally pass the ones early on to keep that momentum going. They want to get you locked into fixed mortgages. At the moment, I don't know the exact number. I think it's in the 70% plus of people are on variable rates, which is not where we have been in prior years. So they will start rolling out products to lock people in on fixed rates, but don't expect them to pass on full rate cuts moving forward. So even if we got a full rate cut, they might only pass on, which is 0.25%. They might only pass on 0.2 or 0.15 of that cut. The banks run quite a thin margin on home loans in general. So the profit on home loans have gotten weaker and weaker as time goes on. They make their money through other revenues, through credit cards, personal loans, banking fees, or all these other ways. They actually make a really large portion of their money. But don't expect for them to pass on the rate cuts in full moving forward through the rest of the year and then next year. So it's just going to be something, I guess, from a market shift in terms of you're sitting here waiting for rate cuts. Then you need to be proactive as an investor and sitting down with your bank or broker and, renegotiating, making sure you're getting the best options available to you at the time as well, because it's not a matter of if, it will absolutely happen when those cuts occur, and then the banks aren't all going to pass them on. So just be something to be aware of.